It's hard to ignore it anymore.
Very hard to ignore.
From soaring inequality and massive levels of debt to rising living costs and economic uncertainty, there's a growing sense that the world's financial system is almost at breaking point. But are we really witnessing the end of capitalism, or is it just another transformation in the turbulent financial merry-go-round of the last 100 years? Today, we explore why the current capitalist system is under unprecedented pressure, look at how we got here, consider some realistic alternatives, and explain what it means for your financial future. My name is Guy, and like the last train home on a Saturday night, this is a video you can't afford to miss. Okay, first things first, you need to know that nothing in this video is financial advice. It's just educational content intended to inform you about the global financial system. If you want to get more content like this, then smash that like button, subscribe to the channel, and ping that notification bell so you don't miss a video. Now, if you're feeling like your savings aren't going as far as they used to, or that something about our economic system is quietly slipping out of balance, then you're not alone. Even if you don't spend your days diving into economic theory or macroeconomic charts, chances are you've noticed the cracks beginning to form in the foundations of our economy. The troubling reality is that capitalism, the very system that's underpinned centuries of growth and prosperity, is facing a serious test. And to understand why, you need to be familiar with something called financial repression. Now, this is an economic term for what amounts to an invisible tax on savers. Financial repression happens when governments and central banks deliberately keep interest rates below the rate of inflation. But why would they do that? Well, because it helps them trim down the global mountain of debt quietly without raising taxes or openly defaulting on their obligations. Now, for those unfamiliar, governments borrow money by issuing bonds, which are basically IOUs, and naturally they need someone to buy these bonds. But with debts reaching astronomical levels, $37 trillion in the US alone, there aren't enough willing buyers. So policymakers have been resorting to a financial sleight of hand, forcing banks, insurance companies, and pension funds to hold these bonds, even though they pay less than the rate of inflation. The result is that your savings gradually lose purchasing power, while the real value of the government's debt declines. Financial historians like Russell Napier warn that this isn't just theory, it's already happening. Japan, for instance, has quietly increased regulatory pressures and provided incentives for financial institutions to hold substantially more government debt. Europe is moving down the same path, and the US isn't far behind. And that reminds me, it's extremely important to note that this isn't some short-term affair. This is a multi-decade trend designed to gradually reduce debt levels by confiscating your wealth through inflation. But that's not all. As governments squeeze savers, consumers are getting squeezed from another angle. Consumer debt, in the form of mortgages, credit cards, student loans, and newer forms like buy now, pay later schemes, is ballooning out of control. Total household debt in the United States recently topped a staggering $18 trillion, an unprecedented figure. Credit card debt alone has surpassed $1 trillion, with interest rates averaging over 20%. And these aren't just statistics, they're everyday realities. Millions now depend on credit cards, not for luxury spending, but to cover basic necessities like groceries, utilities, and medical bills. Meanwhile, student debt burdens are crushing a whole generation, with many forced to delay buying homes or starting families. Mortgages, once the cornerstone of the American dream, now consume ever larger shares of monthly incomes, thanks to soaring home prices and high interest rates. And if you want to dive deeper into the US consumer debt bubble, then check out our video on it right over here. Now, what's particularly troubling is how all these issues interconnect. Financial repression and consumer debt aren't isolated. They're symptoms of a broader economic malaise that's quietly draining the purchasing power of ordinary people. Real wages in America have barely budged for decades. Today's typical worker earns almost the same as they did back in the 1970s when adjusted for inflation, despite enormous gains in productivity. Meanwhile, assets like real estate, stocks, and commodities have soared in price, primarily benefiting the already wealthy. This is the invisible engine driving another systemic problem: inequality. As central banks flood markets with cheap money through quantitative easing, or QE, they boost asset prices, creating paper wealth for those who already own these inflated assets. But the vast majority, whose wealth comes mainly from wages and savings, see their purchasing power steadily erode, creating ever more inequality. Now, to truly grasp how we got here, we need to step back into history. Interestingly, capitalism wasn't always here, nor was it always dominant. Like every economic system, it emerged from the ashes of what came before and adapted as the world evolved. So let's briefly rewind to medieval Europe, a world very different from our own. Back then, economic life revolved around feudalism. Lords controlled the land while peasants worked it, paying their lords with crops and labour. It was stable, predictable, but stagnant. Little changed, innovation was rare, and upward mobility was almost non-existent. Then, something unexpected happened: the Black Death. When the plague swept through Europe in the mid-1300s, it wiped out roughly a third of the population. Suddenly, peasants were a lot more valuable due to the labour shortage. For the first time, they could demand better terms, higher wages, and greater autonomy. Slowly but surely, feudalism crumbled. In its place, over centuries, capitalism began to emerge, driven by entrepreneurs, merchants, and a new class of innovators who saw opportunities in trade and production. By the 18th century, capitalism had its own intellectual champion, Adam Smith. In 1776, Smith's groundbreaking book, The Wealth of Nations, laid the foundations for modern capitalism, emphasizing innovation, competition, and the famous invisible hand that guides markets. Smith's ideas transformed Western society. Throughout the 19th century, industrial capitalism accelerated economic growth and innovation, creating unprecedented wealth. Factories, railroads, and mass production methods lifted millions out of poverty, and for the first time in history, ordinary people had the opportunity to get ahead. But capitalism also had a dark side. Rapid industrialization produced staggering inequalities. The so-called robber barons, Rockefeller, Carnegie, J.P. Morgan, built colossal fortunes, controlling entire sectors of the economy. Their monopolies eventually sparked a backlash, and by the early 20th century, it seemed capitalism had reached breaking point. It was during this period that the sharp critiques of capitalism, offered decades earlier by Karl Marx, gained renewed attention. Marx had predicted that capitalism would inevitably collapse under its own contradictions, arguing that it concentrated wealth at the top and exploited the working class, creating tensions destined to explode. And yet, capitalism didn't collapse. Instead, it adapted. In the early 1900s, US President Teddy Roosevelt intervened, breaking monopolies and introducing worker protections, helping stabilize capitalism for decades. Later, following the Great Depression, Franklin Roosevelt introduced even broader economic reforms, the New Deal, cementing capitalism's reputation as adaptable rather than rigid. After World War II, capitalism adapted again. Robust welfare states, strong regulations, and widespread unionization ensured prosperity was broadly shared. Economies boomed, middle classes grew, and standards of living soared. Many considered capitalism perfected, stable, prosperous, and permanent. But capitalism's evolution didn't stop there. By the 1980s, driven by free market ideologies, many regulations were dismantled and governments privatized industries previously considered to be public goods. Globalization allowed corporations to access cheaper labor abroad, increasing profits but stagnating wages at home. Fast forward to 2008, when these imbalances finally ignited the global financial crisis. But instead of allowing capitalism to reset itself, Central banks intervened with unprecedented monetary stimulus, flooding markets with cheap money. Initially designed as emergency measures, these interventions became permanent fixtures, further distorting markets and fueling asset inflation. Which brings us to today, with capitalism facing yet another inflection point. Its historical strengths, innovation, adaptability, and growth, are undermined by soaring debts, extreme inequality, stagnant wages, and over-reliance on financial manipulation. Now, these are not new problems, but they've reached unprecedented intensity, suggesting that this time may truly be different. Hey everyone, sorry to interrupt the video, but I just want to very quickly tell you about the Coin Bureau Deals page. This is the place where we put together all the amazing deals and promos that we're able to offer you guys exclusively as viewers of this channel. Head on over and you will find such things as discounts on hardware wallets, some seriously impressive trading fee discounts on some of the best exchanges, as well as some frankly mind-boggling sign-up bonuses for some of those exchanges too. The link is down below. Check it out when you have a moment. Thank me later. And now, back to the video. But this raises the question, is capitalism capable of yet another adaptation, or has it finally run out of ways to reinvent itself? After all, capitalism has always navigated its ups and downs, prosperity followed by recessions, corrections, and resets. Yet today's problems feel fundamentally different, as structural issues now threaten capitalism's very foundations. First, let's talk about growth. Growth has always been the lifeblood of capitalism. Historically, periods of significant growth were driven by major innovations like railroads, electricity, mass production, automobiles, the internet, and smartphones. Each of these eras not only transformed society, but created millions of new jobs and industries, expanding prosperity. But look around today. Where is our next great growth driver? Sure, we have incremental advancements in technology, AI, blockchain, renewable energy. But none have yet matched the transformative scale of earlier innovations. Without powerful growth drivers, economies struggle to generate real, broad-based prosperity. Instead, we've become reliant on artificial means, financial engineering like QE, ultra-low interest rates, and unsustainable government borrowing to maintain the illusion of growth. Then there's inequality, arguably capitalism's greatest vulnerability today. Decades of financial engineering have driven asset prices skyward, benefiting those who already own those assets, stocks, bonds, real estate, etc., but not ordinary workers who rely primarily on wages. The result? Wealth gaps have widened dramatically. The average American CEO now earns roughly 200 times the wage of their average employee, while the top 10% of wealthiest Americans own over 90% of the US stock market. Historically, capitalism maintained stability because rising wages allowed ordinary people to purchase goods and services, fueling further growth. But today, with real wages stagnant, this growing imbalance threatens capitalism's central logic. If ordinary people can't afford to consume, then how can consumer-driven capitalism survive? Adding fuel to the fire, meanwhile, is technological disruption, specifically automation and artificial intelligence. Now, technology has always displaced jobs, but historically it's also created new industries and opportunities. Today, though, automation is displacing not only manual labor, but also white-collar jobs, from finance and accounting to legal services and even software engineering. Millions of people risk becoming economically irrelevant, permanently removed from the consumer equation. And AI and robots don't consume, so this also creates a problem for consumer capitalism. And then there's the rise of what experts increasingly call techno-feudalism, platform economies dominated by a handful of giants like Amazon, Apple, and Google. Unlike traditional capitalism, where profits reward innovation, these platforms increasingly generate revenue by controlling essential services and extracting rents. Apple, for instance, takes a substantial cut from every App Store sale, not due to innovation or competition, but simply because they control the marketplace. This isn't entrepreneurial capitalism, it's digital rent extraction, echoing medieval landlords collecting rents simply because they controlled the land. When capitalism's foundational mechanism, profit through innovation, gets replaced by profit through control, it fundamentally changes the system's incentives, stifling genuine competition and innovation. So, all these factors, weak growth, financial repression, extreme inequality, technological displacement, and digital rent extraction, combine into what many now call late-stage capitalism. Unlike previous economic downturns, these aren't isolated, temporary problems. They're structural and deeply interconnected, creating a uniquely dangerous scenario. So, if capitalism is indeed approaching a critical turning point, the big question we must ask is, what comes next? Well, one possibility gaining attention, but perhaps veering into the realms of science fiction, is the idea of a resource-based economy. Proponents imagine a world where advanced robotics, automation, and AI produce everything we need, ending scarcity altogether. In theory, money and traditional jobs could become obsolete, freeing humanity to pursue more meaningful activities. And regardless of how realistic or not this scenario might be, the rapid advances in AI and automation mean it's an idea we'll probably be discussing for a long time to come. Now, if this feels overly futuristic, a more immediate alternative is universal basic income, or UBI, a concept receiving increased attention as automation threatens existing jobs. UBI involves giving every person a guaranteed monthly payment to cover basic living expenses. Programs similar to UBI already exist, such as Alaska's Permanent Fund, which distributes oil revenues to state residents. And more recently, entrepreneur and politician Andrew Yang popularized UBI through his Freedom Dividend, proposing to fund monthly payments using profits from big tech firms, today's equivalent of oil giants, given their extraordinary wealth accumulation. But funding UBI remains a critical challenge. If financed through taxation, it could trigger deflation as individuals use payments primarily to repay debts, reducing money circulation and potentially destabilizing the economy. Alternatively, funding UBI through money printing, as happened with pandemic stimulus checks, might drive inflation and worsen wealth inequality, enriching corporations as consumers spend their payments on products and services from large businesses. UBI trials also reveal complex effects on productivity. Studies show that recipients often use additional income to reduce working hours, improving personal well-being, but potentially lowering overall economic output. Reduced productivity would complicate funding UBI sustainably through taxes, forcing reliance on inflationary money printing, a scenario policymakers understandably seek to avoid. And more importantly, UBI could just end up with all this money being funneled right back up to the top as consumers spend this money at the same corporations paying for UBI in the first place. And we actually have an entire video on UBI, which you can check out right over here. Now, another path forward lies in decentralized, crypto-based economies. While there is undoubtedly a lot of plain speculation in the crypto market, cryptocurrencies like Bitcoin and Ethereum offer an alternative financial infrastructure outside traditional banks and governments. Crypto could enable decentralized economic communities, potentially mitigating inequality by redistributing financial control away from central authorities. That said, though, crypto isn't a silver bullet. While it could help reduce centralized power, it doesn't inherently eliminate inequality or ensure economic stability. Still, it represents a significant alternative, especially in an era marked by financial repression and increasing government oversight. And then there's perhaps the most moderate and immediately feasible solution: reformed capitalism. History provides some clear examples of successful reform, such as in the early 20th century, when big corporate monopolies were dismantled, restoring balance and fostering competition. Similar reforms could happen today, breaking up big tech monopolies like Google, Amazon, and Apple, closing loopholes benefiting corporations and billionaires, and investing heavily in education, infrastructure, and innovation. Such measures wouldn't abandon capitalism entirely, but could reshape it significantly, making it fairer, more competitive, and, ultimately, more sustainable. And of course, capitalism isn't the only alternative economic framework. Meanwhile, other systems, such as democratic socialism or cooperative models, each bring their own sets of strengths, weaknesses, and complexities. However, unpacking them in depth would require a whole video of its own, so we'll leave that for another time. Ultimately, though, the most realistic outcome might involve elements of multiple solutions. Perhaps reformed capitalism combined with targeted UBI, decentralized crypto economies, and strategic government interventions. Then again, some might say we're not far off from that already. Alright, so we've taken quite the journey today, from capitalism's past successes through its present strains to the realistic alternatives that might shape its future. But what do these seismic economic shifts mean for markets, and how should you position yourself to stay secure and perhaps even profit from this seismic shift? Well, first, it's important to recognize that uncertainty itself is the primary risk factor here. Markets absolutely hate uncertainty, and nothing breeds uncertainty more effectively than questions about the fundamental viability of our economic system. Whether capitalism evolves, adapts, or gets replaced entirely, even just the discussion of any changes creates volatility, something you should absolutely expect more of going forward. But volatility isn't necessarily a bad thing as long as you're prepared. Each major economic shift creates clear winners and losers. The key is knowing exactly where the risks lie and where opportunities will emerge. So let's start by clearly identifying the sectors most vulnerable in this new economic reality. Traditional financial institutions, especially banks and insurers, are particularly exposed. Financial repression, as we discussed earlier, directly attacks their profit margins. Central banks forcing bond yields below inflation steadily squeezes banks' earnings, making them less attractive investments. So, having exposure to traditional banking stocks or bonds might not yield you great returns. Another sector heavily at risk is consumer-facing industries, be it retail, automotive, or housing. These businesses depend heavily on consumer purchasing power now eroded by record household debts, stagnant wages, and increasing living costs. Companies that rely on consumers borrowing more just to keep spending are likely to struggle, especially if economic conditions deteriorate further. Also vulnerable are passive investment vehicles, large cap index funds and ETFs, often viewed as stable, conservative investments. As discussed, institutional investors may soon face new mandates, forcing them to shift capital into government bonds. If that occurs, large-cap stocks heavily represented in these passive indices could face significant downward pressure. Okay, but enough with the gloom. Where are the opportunities? Well, first, consider hard assets. Gold, silver, commodities, and selected real estate have historically performed well under financial repression and inflationary conditions. Central banks themselves are increasing their gold reserves, signaling they expect persistent inflation and currency debasement. So, incorporating hard assets into your portfolio could offer essential protection against these risks. Additionally, look to industries aligned with government spending priorities, sectors like infrastructure, energy, healthcare, and defense. In an era of massive public debt and rising social pressures, governments globally will increase fiscal spending substantially in these areas. Now, we must also talk about crypto. Truly decentralized cryptos like Bitcoin and Ethereum exist outside traditional government controls and central banking systems, making them uniquely attractive as hedges against financial repression, inflation, and potential capital controls. Now, of course, crypto comes with volatility and regulatory uncertainty, but it's clear by now that it isn't going away. As traditional financial systems strain under growing government intervention, crypto's attractiveness as an independent financial ecosystem will likely continue to rise. And beyond focusing on specific sectors, navigating this uncertain economic environment also demands a shift in your overall investment strategy. Two principles stand out as particularly crucial in times of fundamental economic change: geographical diversification and active portfolio management. So, starting with geographical diversification, history clearly shows that economic turbulence rarely affects all regions equally. By diversifying your investments across multiple countries, currencies, and markets, you significantly reduce your exposure to risks concentrated in any single economy. An active portfolio is also crucial, giving you the flexibility to respond swiftly to changing conditions. Instead of simply buying index funds and holding long-term, active strategies enable you to reposition your investments in response to policy shifts and market volatility. But what's the bottom line? Well, one thing is clear: the next decade won't look anything like the last. And while it's unlikely that capitalism will collapse anytime soon, markets and economies will undeniably undergo substantial changes as capitalism evolves, or perhaps even transforms into something quite different. And as always, we'll be here every step of the way to help you get through this turbulent time, because in investing, as in life, knowledge truly is power. Okay, now, if you're curious how crypto could become the saving grace of this economic shift, then check out our video on it right over here. And if you haven't subscribed to the channel yet, you can do so right over here. Thanks so much for watching, and I'll see you again very soon. This is Guy, signing off.